how would where would you actually be paying taxes, whether you are traveling, what are the 182 or 120 days, as they say, for NRIs. These nuances is what is going to be touched today. So without taking much of your time, I would like to thank, first of all, our esteemed speaker, Mr. Ajay, for accepting our invite and being gracious enough. He's also a member of our chapter and very well versed with NRI taxation. So please feel free to touch base on all the questions that you have. Put it in the chat box and let him take through the session. Do not disturb him midway. Put all your questions in the chat box. He will answer as much as he can. But again, I would like to also thank our XCOM member Manish Saraf, who has put a lot of efforts in the tax focus group. And yes, got this webinar to you all members for the benefit. This was actually requested by one few of the members. This topic was particularly requested by few members. That's why we have taken it up. And this is the right time. I think filing is now due in India as well. So please take the maximum benefit of it. And today we have our XCOM meeting. So we have our chairman also here along with us. I would like to include him to request him to say a few words.
Hello, everyone. Nice to meet. And thank you all for joining. We have just returned from our China trip, which was also quite interesting, and a lot of our members have joined, and we had a great turnout. We had about 87 people joined, members plus their family. It was a great event, and we are back to learnings yet again, and we have a very interesting topic. And thank you to Manish for selecting such an important topic on the NRA taxation. I think as NREs, we're sitting here. The main concern for us is what is the tax impact for the earnings we make here or the money we transfer back to India. So there are a lot of changes which has been happening, and even recently we had a meeting with the ambassador office, and there was some discussion, and they were also interested to see that what kind of learnings we are sharing with our members about the changes on the NRI taxation side, which has been taken up in India. So very apt and timely done. So thank you very much, Manish, for organizing this. Over to you to take it up, and let's start the session. Thank you.
Yeah, good evening all. Thank you, Chairman, for that wonderful introduction, and Ashna Madam to take us through this. So first of all, welcome you all this evening. Today we have a special topic on NRI taxation, and special thanks to our speaker Ajay Vaswani. And I've been connecting with him over last couple of months to see how we can schedule this. And whenever I've been reaching out, he's always been available and accommodated his time to have this session. And it is important that we invest in India. We have a tax liability, and how do we repatriate that funds here? So he carries 14 years of experience specializing only in the NRI taxation, and he has been serving clients across 20 countries, and he has been regularly presenting in different seminars and been to Singapore and other countries where he has shared his wide knowledge on this taxation of NRI, and different updates which have recently come in terms of the union budgets 2026. So he will share his key highlights. So as Ashna Madam mentioned, please list out your queries, whatever you come across, during this session, he will talk about. So post it in the group, and we will have a question answer session, and Mr. Ajay will address all those queries. So without further wait, I will invite Mr. Ajay, who is a chartered accountant and a law graduate and specializing in the NRI taxation. So please welcome Mr. Ajay. Over to you.
Thank you so much. And in fact, I would like to extend my thanks to Chairman Rishi sir, Secretary Ashna Madam, and Manish sir for having me on board today to talk on a topic which I would say is ignorant for an extent. Okay, and while I present, you will understand why I'm saying this topic. And we'll just quickly share my screen. Can you just confirm if my screen is visible?
Yes.
Got it. Thank you so much. So let's start the journey of demystifying NRI taxation. This is a very important topic, and particularly for NRIs who are in Gulf, I always say that you are way different than NRI in any other part of the world. So income tax, FEMA, there are two primary rule books which governs you as a non-resident Indian, but none of the act, none of like provisions of the income tax of FEMA rule book differentiate a non-resident Indian based on the country he is living. But still, I always say there are two reasons why NRIs in UAE are way different than NRIs in any other part of the world. So if you have to compare yourself with NRIs sitting in US, Canada, Singapore, or Australia for that matter, you see two particular differences. The first difference, most common being you don't pay any taxes over here. So whatever you are earning over here, you don't pay any taxes on that. So that is one particular difference about this country. And since you are not paying taxes here, at times you are not accustomed to the habit of paying taxes and filing the income tax return, and you are away from the country for 2 3 years, you tend not to be updated with the rules and regulations, because India is ever changing rules and regulations. Every another day there is a new amendment, there is new rule coming in, and in fact this year the entire income tax has come in. So this is very important. And second major difference, if I have to tell you, and you will connect me with this part, this country doesn't give you a PR. So for a fact that what you can do is you can postpone your stay over here, but considering the day you don't have your visa, it is certain you are flying back to the country, and that is your home country, which is India. And perhaps that is one reason which connects you more to the mother country. Now compare yourself again, I will say, to a person who is in US who gets a passport over there. They feel that okay, we are citizen of that particular country, we have anyway limited connection back in India, and so the investments also reduce. But for you, things are very different, considering the limited investment opportunities available. And if you have to leave last 4 5 years, so someone who has been here for a decade, 2 decade, you imagine what was the investment opportunities you had. So it was always and always that money was going in into maybe real estate. That was one very hot favorite of NRIs. Then mutual funds are there, shares are there, there are business investments happening there, there are deposits, then there are FCNRs. So more or like many investments were done back in India. And when these investments are being done in India, that is where this subject comes to an importance. And since income is coming in, so taxation rules and regulations come in. So the whole objective today is to take you through the rules and regulations. What are the important do's and don'ts that while you should be doing or not doing as a non-resident Indian? And perhaps I would be speaking for another 60 70 minutes, and you will actually feel that you are sitting in your inter class today. So you will be remembering your professor way back when we used to start studying taxation in the inter level. Okay. And let's start with the technicalities around. So if you have to see residential status, before that we need to understand the income tax rule book. So recently Income Tax Act 2025 has been introduced effective from 1st April 2026, replacing the old 6 decade old rule book which had almost 800 plus sections. Now they have been reduced to approximately 536. What major change here is the concept of assessment year and previous year has been done away with. Now we would be using only the word tax year like we say in UAE for that matter. So if I say April to March 26 27, it is tax year 26 27. We would not be using the word previous year or assessment year this year onwards. Let's talk about the residential status. There are two different rule book which governs the definition of an individual to be called as a non-resident Indian. One is Income Tax Act, which was 1961, now replaced by 2025. And there is another rule book, which is FEMA, Foreign Exchange Management Act 1999. Both are very independent in a way that they don't talk to each other. Their objective is completely different. So an individual can be resident as per income tax, non-resident as per FEMA, and even vice versa for that matter. So we have to see the perspective and the objective of both the rule books to understand what criteria we fit into. So income tax, everyone knows that this is more about a revenue law, and we check the residential status year on year to understand what is our total effective tax liability. Are we resident or non-resident for that matter? This is the whole objective of income tax. But FEMA, this is more of a regulatory law, and this tells you what transactions you can do in India, what bank account you can have, how the financial transactions that you are doing will be regulated. So all that is the objective of the FEMA. And FEMA, unlike the income tax, which sees the number of days, sees only the intention. So if you are leaving India for employment purpose outside India, you are non-resident as per FEMA on the day one itself. because your intention is not to leave the country and go back to India in a very near future. So when your return to India is not ascertained or not sure, that is when you become FEMA non-resident, and this is to be seen every particular day. So if any transaction is happening, we ascertain what is the residential status as per the FEMA on the day of the transaction. So that is the whole objective of FEMA. Let's come to more focus on the income tax part. So income tax doesn't define an individual to be resident or NRI of India. What income tax defines is an individual to be resident of India, and any person who is not a resident of India is considered as non-resident Indian for that matter. And what we have to see is we ascertain cumulatively the number of days you have spent in India. So starting from 1st April to 31st March, that is the India financial year, we see the number of days you have spent in India, and that tells us exactly what is our residential status. And while we
बहुत सारा
calculate the
webinar
number
मच
of days,
टैक्स
we have
आपको
to
इंडिया नो
see
टैक्स
the day you land in India and the day you take off from India, both
अप्रूव
the
થઈ ગયું
days
તારું
are considered you are in India for that
મને
matter.
ફોન આવશે
For
ફોન
the
સાથે
reason
રાખતું
we see the India immigration entry and exit stamps.
રેકોર્ડ નહીં
You have to arrive at, say, Mumbai airport and you cross the immigration at 11:45 on 3rd June today. Though you have spent only 15 minutes in India, but income tax will consider the entire day you have spent in India. So being a student of tax, being a professional who is working into taxation, if I am at the airport around midnight, I will always see some of the people would wait for 12 o'clock to happen so that they cross the immigration so that the date changes. Because someone who is flying very aggressively in and outside India would be very mindful about the number of days he is spending. So next time you are at the airport around 12 o'clock, do observe that people would be waiting to cross India so that the number of days is reduced while we calculate. Second, what you have to understand, it is purely based on the number of days you spent in India is your NRI status calculated. It has nothing to do with the passport you have, the visa you have PR of any another country. It really doesn't matter. It is absolutely and purely based on the number of days you spent in India. And if we go into the definition part of income tax, who is a resident of India, there are two basic conditions. Condition number one is, in case your stay exceeds 182 days or more in a given financial year, you become tax resident. And there is one more condition, which is where we see 60 days in the previous year and 365 days or more in last preceding 4 years. So here we are seeing a span of 5 years. So first year 60 days and additional 4 years before that we see 365 days. In case you cross this, then also you become tax resident in India. So we will come on this part. There are few exceptions, but before that, once you become resident of India, there are two sub-classification that we need to see. So category is either you are a resident and ordinary resident in India, or you are RNR, that is known as resident but not ordinary resident. So there are two additional conditions which we see. And in a scenario where both the additional conditions are being fulfilled, you become resident and ordinary resident. And in case any of the condition is being not fulfilled, you become RNOR. So let's see what are the two additional conditions. So condition number one is, we see a period of last 10 financial years and see that were you resident in India in at least 2 out of those years. So someone who has been resident in 2 out of 10 years, that is the condition number one. And second condition we see is, was your stay in India exceeding 730 days in last 7 financial years. So when both the conditions are being fulfilled, you will become ROR. Any one condition not fulfilled, you become resident but not ordinary resident for that matter. Few of might be thinking on the 60 and 365 day condition. So there are three exceptions available to that. In a scenario where these three cases come in, we are not going to see the condition number two. We are only seeing the condition number one, which is the 182 days. So condition number one is where an Indian citizen is leaving India for the employment purpose. So given said that, say tax year 26-27, right now it is June 26, someone comes to UAE for employment purpose, stays more than 183 days outside India, and for that matter, say in UAE, he becomes non-resident Indian in the year one itself. So this is an individual who is leaving India for the employment purpose. The first year we are not going to see the condition number two. Second exception is for the crew member of an Indian ship leaving India. Third, this is very relevant for you. I believe everyone joining here is already a non-resident Indian living in UAE. What you do is you visit India only for a very limited purpose. So this is for you. Indian citizen or a person of Indian origin coming on a visit to India. So your visit to India is only for a limited period of time, and you are certain that you are coming back to the Dubai for that matter. For you, if your total taxable Indian income, this is excluding the foreign sources, I am only talking about the taxable Indian income, which does not exceed 15 lakh. So in a way, if your total Indian income is less than 15 lakh and you are going to India only for visit purpose, then the condition number 2 is not to be seen for that matter. Now, second question comes in, Ajay, what if my total Indian income exceeds 15 lakh? In this scenario, the concept is we have to replace 60 days by 120 days. So we see that 120 days or more in the previous year and 365 days or more in preceding 4 year, then your residential status is called as deemed resident, and taxability will as good be as RNOR for that matter, not ROR. So this is one major difference. Even though if your Indian income is exceeding 15 lakh, you cross more than 120 days in India, you become deemed resident and your taxability is as good as RNOR. Let us understand how does the taxability metrics works in. So said that you have income coming in from two sources. So being living in UAE, of course, you are working over here. You would be into consultation, you would be into business, you would be into practice or employment for that matter. Whatever income you are earning here is your foreign income. And out of all the savings we are doing, we are putting money into India. We are buying various category of assets which are generating income for you. Those are income which is called as Indian income for that matter. So if we have to see the matrix for the Indian income, irrespective of your residential status, you be ROR, RNOR, or NRI for that matter, it is always taxable in India. So any income which is received in India, which is accrued in India, is always taxable in India, irrespective of your residential status. But coming on the foreign income part, this becomes taxable only when your residential status is ROR. So in a way, while you are a non-resident Indian or you are RNOR for that matter, the foreign income, which has no relation to India, is always exempt from taxes. At times, I get a lot of queries from NRI that Ajay, I'm earning over here, I'm into employment. I transfer money to my parents in India, or I'm transferring money to buy an asset in India. What is the tax consequences on that? So if any income which has been primarily received outside India or accrued outside India, the first point of contact for the receipt of income is outside India. You transfer this money for your saving purpose or investment purpose in India. There is no taxability coming in on that. So this is mere occasion that transfer is happening from one bank account to another bank account. However, if you are earning over here, working over here, and you get income in India for that matter, then it becomes taxable. Then foreign income is taxable because the place of receipt or the accrual of the income is India for that matter. So this is either of the condition we have to check while ascertaining the taxability of Indian income and foreign income. So primarily, there are two types of taxability of income. Either it would be a flat rate, wherein it is very specified. In case it is not a flat rate of tax, then income is chargeable to tax as per the slab rates. So for financial year 25-26, if we see, in fact, for financial year 26-27, it is also very same. There is no change in the budget 26, which was recently brought in by the finance minister. So new regime is the most popular one. Approximately 75% of the people last year opted for the new regime, where you have to forego the deductions you used to get like for ATC and ATD, and you get a better tax regime. So till 4 lakh, you don't pay any taxes. Every additional 4 lakh, there is increase in the tax rate by 5%. And when your income actually exceeds 24 lakh, you get into the 30% bracket. And there is big confusion here. A lot of people think that till 12 lakh, you don't have to pay any taxes in India. So this is right to an extent, but this is applicable only to an individual who is a resident in India and has total income less than 12 lakh. This is not applicable to NRI. Thanks to WhatsApp University, I personally have been into so many NRI groups I read. People think that till 12 lakh, you don't have to pay any taxes. And that is where the confusion comes in. So this is applicable only to individual who is a resident of India and not for an individual who is NRI for the residential status purpose. So whatever is your total income, surcharge is added over and above your total tax liability based on your total income you have, and 4% education cess is added, thus making effectively your total tax liability as high as 30% plus surcharge, which is maximum 15%, and education cess 4%. Okay. So income tax classifies income into 5 major heads, and that is where we started our journey of learning taxation in CA Inter. So if you see, income tax puts income into 5 heads like salary, business profession. These two are not very relevant for NRIs because you don't have a salary income in India, and very few actually have a business or profession income back in India. But the next 3 heads of income are very important, and I'm sure everyone who is joining here would have income coming in from these 3 heads. So it is house property, capital gain, and other sources. Other sources is a residual clause where any income which is not classified into the 4 major heads is put into other sources. Let's focus more on the house property income part. And though the title is house property, but it is very broad category. Any immovable asset you have in India and you give it on rent, any income coming in the form of rental is part of this head of income. And this is not restricted only to residential house. This is very broad category. This is equally applicable to maybe say a land, commercial office, shop for that matter. So if the property has been let out, whatever is your gross rent, government gives you incentive or a deduction in a way of 3 forms. Number one is for the municipal taxes that you have paid on the actual basis. The year you pay the municipal taxes, that year you are allowed to take the deduction. Second, government says, but obvious if you have a property in India, you would be spending some money over the repair and maintenance. So instead of going SSC by SSC or properties by property, government says we will give you a flat deduction or a standard deduction of 30%, which covers all your expenditure. So now you do the expenditure or you don't do, you do less or more, irrespective of the fact that government is giving you 30% deduction. So whatever is your gross rent minus the municipal taxes, you will take 30% deduction of that. And third deduction that you get over and above this is interest that you have been paying on a housing loan. Whatever is the net income, this becomes part of your taxable income, and you have to pay tax as per the applicable slab rates, which is the progressive rates you have in India. What is important over here is concept of tax deducted at source, and I'm sure everyone would be aware of the fact that TDS rate for NRI is always at the rate highest on which you have to pay tax. So highest slab rate being in India is 30%. So TDS rate is also 30%, and education says added over in that, making it effectively 31.2%. So any amount that is paid as a rent to a non-resident Indian tenant is required to deduct TDS at a rate of 31.2% and deposit it to the government. And this is every time, irrespective of the income, whatever is being paid. So you are getting a rent of 5,000, 50,000, or 5 lakh for that matter. The tenant is required to deduct TDS and do the compliance. So very many of the occasions we see the tenants are not doing, and people are worried for that reason that the compliance is being not done. So as a non-resident Indian, there is no worry for you. This is onus on the tenant to do the compliance. So nothing is coming against you. And while if you are a resident of India and you are receiving a rent of rupees more than 50,000 per month, then the tenant is required to deduct TDS at a rate of 2%. So that is how, see the variation now. NRI 31.2%, resident it is 2%. Then there is another very important concept, and I would request attention of all the members for next 5 minutes while we speak this. So the concept is deemed rental income, and of late this has been become very hot topic for the assessment while it is being done for the income tax officers in India. This concept is limited to residential house property. So earlier we were talking about house property, which is very broad in nature, but the deeming fiction that we are talking now is applicable to only an asset which is residential house in nature. So any property where you can live is actually a residential house. So this is applicable only on that. And the provision says, government says, if you have more than 2 residential house property, that is maximum you can keep it for your own occupation purpose. And in case you have more than 2 house property and you saying that this is vacant, you have to calculate the fair market value of the rent you can get, and that becomes part of your total taxable income. Of course, you are getting the reduction for municipal taxes and 30% reduction, but deeming fiction comes in. And this is the only provision in the entire Income Tax Act which levies tax on an income which has never been paid to you or will never be paid to you. So let me give you an example. So an NRI based out of UAE for that reason has 5 immovable properties in India, and which is residential house in nature. And he has not given any of the properties on rent. What government says, highest of the 2 rent giving properties, you can keep it for your own occupation purpose. So out of 5, highest 2 potential rent giving properties, I will keep it for my own occupation. And the balance 3 property, I have to figure out as per the sub registrar, what is the fair market value of the rent I can get. Take 30% deduction, take municipal taxes deduction, and balance becomes part of my taxable income. So this is you have to be very cautious if you have more than 2 properties in India. Okay, so next head of income is capital gain. Capital gain comes in from two various assets. Either it is an movable asset or a removable asset. What you need to understand over here is two concepts primarily before we get into the taxability of the capital gain. One, taxability of capital gain comes in India only when the asset is sold. So unless and until the asset is not realized, there is no capital gain tax coming in. And why this is important? Because when you switch a mutual fund, that is also a taxable event. So you are selling a mutual fund, buying a new mutual fund. Many a times we see people are not aware about the fact that switch is also an event where you are actually realizing your old investment and buying a new investment. So this is important to note. Second, to ascertain the capital gain tax rate, we see the period of holding. This is very important because either the asset can be a short-term capital gain in nature or long-term capital gain in nature. If it is long-term capital gain in nature, government gives you incentive by reducing the effective tax rate on that. So let's talk about the various movable assets. Our list is very exhaustive, but let's focus more on the prominent one being your listed equity stocks or equity oriented mutual funds in India. To ascertain the short-term and long-term, we see 12-month period over here. So if the asset is sold within first 12 months, this is short-term capital gain. Whatever is the gain, you pay tax at a rate of 20%. Whereas if the asset is held for more than 12 months and you sell, this is long-term capital gain in nature, and tax rate is now reduced from 20% to 12.5%. And government gives another incentive here, that is first 1,25,000 of long-term capital gain is exempt from taxes. And there are of course various investments, like if it is debt mutual fund, which is bought after 1/4/23, irrespective of the period of holding, it is always taxable as per the slab rates. Okay. Now coming on the next focus, which is very important, and since a lot of people have investments in real estate and the complications are equivalently good, money is equivalently good, and too much compliances around the real estate taxation in India. Why there are two parts to this presentation. The slide you see is before budget, that is for transactions done till 22nd July 24, and then after budget, that is transactions done on or after 23rd July 24. So this date of 23rd July is very important because this was when the budget was presented in the year 2024, and lot of changes happened to the entire taxability of the capital gain. And most important, the capital gain taxation for NRIs changed forever. So we will talk about the same, and let's understand how does the taxability works in. So for the short term, so the period of holding we see here is for the classification purpose is 24 months. If the asset is held for less than 24 months and you sell it off, whatever is the gain, it is chargeable to tax as per the slab rates, and there is no change in the way we calculate the short term capital gain. So before or after for that reason. But if the asset is held for 24 months and was sold before 22nd July 24, what we used to do is there was a concept of indexation. What we used to do is whatever was our purchase value, we used to bring to the present value using the cost inflation index, which was nothing but cost multiplying factor, which was prescribed by the government year on year. And this was nothing to give effect but to the inflation. So government was saying that no, we will not charge whatever is the actual capital gain, give effect to the inflation and bring your original purchase value to the present value using the cost inflation index. And then whatever is the difference, you pay tax at a rate of 20%. What happened on the day of budget, that is 23rd July 24, government came and said, we are doing away with the concept of indexation and we are reducing the tax rate, which was payable at 20% now to 12.5%. So whatever is the actual difference between your sale value and your purchase value is capital gain, and on that you have to pay tax now at a reduced rate of 12.5%. And this was for everyone when they announced, but there was a good media pressure, people were writing around, and coalition government not in numbers, so government came in pressure, and after a week what did they say? If you are a resident of India, you have both the option to choose wherever your tax liability is coming less, you can opt for that. But when the clarification come in, the word used was only resident of India. So NRIs were excluded. So by that reason, now for if you are a non-resident Indian, the benefit of indexation is absolutely done away for you. Whatever is the capital gain long term, 12.5% tax is to be paid on that now. How do we calculate the capital gain is we see the sale value that you have received less expenses incurred exclusively for such transfer. So if you are paying any commission or a brokerage to an agent who is helping you to do the transfer or any lawyer fees to do the transaction, that is reduced. Then the original cost of acquisition is reduced. And last is your cost of improvement. So any permanent structural changes you have done and which enhances the value of the property, those are called as cost of improvement. And then whatever is your net capital gain, that becomes part of your taxable income. Now one question comes in, Ajay, what happens to an asset which was inherited and is being sold now? So when we calculate the capital gain for asset being sold which was received as an inheritance, the purchase price the original buyer paid is used for the purpose of calculation of the capital gain. So if a property was bought maybe by your parents in 2005 and you are selling it right now, whatever is the purchase price they paid in 2005 will be the actual purchase price for the purpose of calculation of capital gain. Second rider that we see here is what happens if the property was bought way back. So like say if it was bought in 1980 or 1990 for the reason that prices were very less and there would be a good capital gain coming in. So government says in this scenario for any property which was bought before 1st April 2001, you have to see the fair market value or the ready reckoner or the circle rate depending on city to city these words change. You have to see the value as on 1 for 2001 and whatever is the value, that value would be considered as the base purchase price for the calculation of the capital gain, and we are not seeing the original value then. So value as on 1 for 2001 is your purchase value. Today we are selling, we know the sale value. The absolute difference is the capital gain, and on that you will pay 12.5%, that is being your long term capital gain. Okay. So prominently, all long-term capital gain are subject to tax. Government gives incentive by way of reinvestment. So there are three prominent sections which are important for NRIs, which is 54. If you see in the bracket, I have written 82 now. So these are the new section numbers as per the Income Tax Act 2025. So three sections which we would be talking about is 54, 54 EC, and 54F. So section 54 is saying that if you are selling a residential house in India, and if you reinvest the gain amount, only the long-term capital gain amount into buying a new residential house, government will give you exemption from paying any long-term capital gain tax on that. Lifetime benefit that you can take from these exemptions is restricted to 10 crores and there is time limit. So when you are selling a property, government says within a prescribed time limit, you have to buy the new residential house to claim the exemption. So if you are going for an under construction property where like a developer is developing, there is a flat scheme coming up, and or maybe you are buying a land and constructing a house for yourself where construction is involved, then timeline is 3 years from the date of sale that possession should be received for the new property. And if you are going for a ready to move in property, then either 2 years from the date of sale or 1 year prior to the date of sale, if you have acquired a property, that you can claim for the exemption purpose. And whatever new property you are buying after the date of possession, it should be locked in for 3 years. You cannot sell the property from the date of claiming the exemption. So 3 years you have to keep it as lock-in. And considering the reinvestment, you have to look after a lot of options around. It might take time. So what does government says? If this time is falling beyond the due date to file ITR in India, you have to deposit the gain amount into capital gain saving account and claim the exemption when you are filing ITR. And whenever you are decided, okay, I want to buy this property, use this designated bank account to pay to the seller or the developer as the case may be. But timeline doesn't changes from the account opening for this capital gain. It is always 2 year or 3 year or 1 year as the case may be when we have to see, and that is from the date of sale, not from the date of opening of the bank account. Second exemption is in case you don't want to buy a residential house. So government says 54 EC, that is if you have a capital gain when you have sold a residential house in India, you reinvest into specified bonds, and bonds are like REC, Woodco, or NHI was there earlier. So you can put maximum of 50 lakh rupees per annum per person to claim this exemption, and the reinvestment should be done within 6 months from the date of sale. Whatever bonds you are buying are under lock-in for 5 years, and the interest you get approximately 5.25%, and that is also taxable for that matter. So not a very good proposition to look forward to claim as exemption because the return is very less. Okay. Third section, almost everything is same as section 54, but this is applicable when capital gain is coming from sale of an asset which is not residential house in nature. So if you have sold any commercial property or land or shop or mutual funds or shares and securities, and if there is a long-term capital gain, government says you reinvest the entire sale value into buying a new residential house, then you will get the exemption again. So 54 was talking about reinvestment of the gain amount. 54F is talking about reinvestment of the entire sale proceeds. Rest all the conditions are same. There is one more rider. 54F is not allowed in case you already have two residential houses in your name. So including the new one that you are buying, you should not have more than two residential house to claim the benefit of section 54F. There are few more intricacies which we see, but I am not going in today, considering the time restriction we have. Okay, we'll spend some time on the TDS part. This is very important because again, rules are changing for resident and non-resident, and this is equally applicable to you also. So suppose you are NRI today and you buy a property in India from a developer in India. So as a compliance, you also have to deduct TDS when you are making the payment. That is the first rule we would be talking about. So an individual who is resident of India sells a property which is over and above 50 lakh rupees. In that case, buyer is required to deduct 1% TDS and pay net 99% to the seller. And this 1% you have to deposit to the government of India through filing Form 26QB, which has now been renamed to Form 141, coming in the Income Tax Act 2025. And the deposit that you do of this TDS is through your PAN card. Now, if you are selling a property as a non-resident Indian, rules are very different. And what does the government say? Irrespective of the value of the property you are selling in India, the buyer is required to deduct TDS at a rate on which you have to pay tax. So now, what is the tax rate? It is 12.5%. So TDS rate is also 12.5%. Before 24, what was the tax rate? It was 20%. So TDS rate was also 20%. And over and above this, you have to add surcharge and education cess also. So if your value of the property is exceeding 1 crore in India, surcharge applicable is 15%. Education cess applicable is 4%, making it effectively rate of 14.95%. In case your value of the property is 50 lakh to 1 crore, surcharge applicable is 10%, then your effective rate becomes 14.3%. If your value of property is less than 50 lakh, surcharge is not applicable, only education is applicable, then your effective rate becomes 13%. So there are three slabs to that. So considering over and above 1 crore, it is 14.95%. And for this, buyer has to take TAN number, that is TDS deduction and collection account number. However, budget 2026 came in and said that TAN has been removed, but the effective date is 1st October 26 and onwards. So today, if you are selling a property in India as a NRI, the buyer has to take TAN for all the transactions done till 30th September. After that, they would be migrating it to PAN-based form. Okay. One thing very important, and you have to be very cautious when you are planning a sale of a property in India. So tax that you pay is always on the gain value, but TDS is deducted on the sale value. So it is always that an amount on a higher side is withheld by the India, and when you file your ITR, you claim it as a refund. So let us see this illustration and we will understand how does the tax works, the TDS works, and what alternative you have. So first option is, of course, you claim it as a refund. So if like we see this example where my sale value is 1 crore, cost of acquisition is 90 lakh, my capital gain is 10 lakh. What is my ascertain tax liability on that is 14.95%, making it 1,49,000. But since I am an NRI, buyer will deduct 14.95% TDS of 1 crore, which is 14,95,000. So what you do now is when you file your ITR, you tell the income tax, my tax liability is 149. Sale TDS is 1495. The excess of 13,46,000 is processed as a refund to you. But you see, if the transaction is happening now in June 26, financial year will end on March 27, return will be filed earliest in June 27. Considering amount is on a higher side, government might take 3-4 months for the refund to come in. So practically your money, which was not due to the government, is being stuck for a period at least 18 months on an average. In case you don't want this to happen and you want the money to come in with you, you want liquidity available, and for but obvious reason you need money to use it, and perhaps that is the reason you are selling a property. Government says you have an option available where you can apply for a lower TDS certificate, which is earlier Form 13, now called as Form 128, wherein after you have identified the buyer, we ascertain the computation of income and we see what is your total tax liability. We tell the income tax office along with all the relevant documents and details. See, my total tax liability, a certain tax liability on this transaction is only 1,49,000 on a sale value of 1 crore, which is effectively 1.49%. So on his satisfaction, officer will issue me a lower TDS certificate mentioning 1.49%. I give this certificate to the buyer. Buyer will deduct only TDS at a rate which is mentioned in the certificate, thus making your TDS rate equal to your tax liability. So then there is no question of excess being withholded and you claim it as a refund later on. So this is something everyone should do. A lot of times people ask me, Ajay, what is the timeline? So normal timeline is 2 months to get this certificate on an average. But considering we have been doing a lot of cases, someone who understands Nri taxation can get the certificate within 7 to 15 days also from the income tax department. Okay, coming to the next head of income, which is very prominent and a very hot topic among all the NRIs, especially in UAE or Singapore for that matter. And perhaps everyone would have read somewhere that mutual fund is exempt from tax. And this is a new amendment which has come in through which NRIs in UAE can claim the taxes as an exempt, whatever mutual fund capital gain you have. So this is out of actually judgment which has come in, and this is 24 and 25. Prominently, 3 judgments came in. So if you see the judgment, one is Saket Kanoi, which is a 24 judgment. Then there is KE Faisal, another old judgment of 29, which has some relevance to that. And the important one was Anushka Shah, Singapore-based NRI judgment, which came in March 25. And these judgments came in actually from a Delhi tribunal and Mumbai tribunal. So India has total 3 tribunals. Out of that, 2 have given a judgment saying that India and UAE have a double tax avoidance agreement. And what does agreement says is, and this is not a very recent amendment, first of all. So India and UAE double tax avoidance agreement was signed way back in 1993. So it has been there for 3 decades. And recently, of course, there were a couple of amendments, but that too was in 2016 or 17 for that reason. So every article in the DTAA specifies about taxability of head of income and which country has the right to tax the same. So like if it is immovable property, it very categorically states that it would be taxable in the country where the property is situated. So if property is situated in India, NRI, and UAE, India has the right to tax the same. Then there is sale of shares, which is your equity shares. It is very specifically mentioned where the stock is listed, where the major assets of the company are. It would be taxable in the country where the stock is listed. And then there is a residual clause, which is now I'm talking about is Article 13, Clause 5 for the UAE double tax avoidance agreement. It states any other asset. What does it say? I will read for you. If a UAE resident sells any other type of property not mentioned above, means it is not immovable property in nature, it is not shares of a company, the gain is taxable only in the country where the seller is resident, that is UAE. Since mutual fund is not immovable property, mutual fund is not listed shares of a company, this is where it comes into the residual clause. So these 2 NRIs which we are talking actually filed their income tax return in 21 and 22 and claimed the exemption out of the double tax avoidance agreement. At the first instance, income tax officer denied the benefit. Of course, escalation came in. The matter went to the DRP, which is the next level in the hierarchy if you have to go for an appeal. DRP also rejected the matter, stating that no, this is a taxable capital gain and tax has to be paid in India. Agreed further, the matter went into the tribunal, which is the highest decision-making authority within the income tax framework. And after tribunal, then it is of course High Court and Supreme Court that it comes in. And then High Court and Supreme Court talks only about the matter of law, not the matter of facts. So tribunal said that whatever interpretation are there by these three individuals is absolutely right, and this is the whole intent and the legislation purpose that it has been drafted, that it should be taxable in the country where individual is resident of. Since UE doesn't have any income tax on capital gain, or for that matter even on personal taxes, this is how this becomes exempt. And last year, that is financial year 24-25 and then 25-26 now, would be prominently first and second year where the applications are coming in, the income tax department is processing the refunds, and that is how the momentum came in. For us, we have been doing this since 21 and 22 and almost 4-5 years now, and we haven't faced any litigation till now because there is precedence to it. So any officer cannot go against a judgment of the tribunal stating that no, this is not allowed. So unless and until the DTAA is modified now, this exemption has to be there. How do you claim exemption out of this is, uh, okay, so I will come on the part that what additional benefit are there, and then we talk about the how you get the exemption. So like we said, mutual fund capital gain is exempt for NRIs, and it doesn't talk about which bank account you have used for the investment. You do the investment from your NRO bank account, you do it from your NRE bank account, or you have bought the mutual fund while you were resident of India and selling it now, irrespective of that. Okay, all the mutual fund, be it short term, long term, are exempt from taxes. There are two more benefit available out of the double tax avoidance agreement. One is dividend. So if dividend income is received by any NRI, it is taxable at a special rate, which is under section 115A1A, which is 20%. So this is a very important pitfall, and let me make everyone cautious over this part, that if you are resident of India, dividend income is taxable as per the slab rates. But if you are a non-resident Indian, it is taxable at a special rate of 20%. And using the double tax avoidance agreement, you can bring down this 20% to 10%. This is the benefit number 2. And third benefit you get is on the interest income. So interest income is chargeable to tax at slab rates, highest being 30%. That you can bring down to maximum of 12.5%. Let me very clearly say that there is no judgment available for interest and dividend, but judgment is available for capital gain. Considering the same precedence, the same agreement we are talking, we can take the benefit of dividend and interest also. And the mutual fund benefit is available to almost all the countries in Gulf except Bahrain. Then Singapore-based NRIs are there, few European countries are there, and of course Mauritius is there. How do you claim this exemption is, you have to just fulfill two conditions. Number one, be NRI in India. Second, be tax resident of UAE. So NRI, we have already seen the definition as per the income tax. When I say tax resident of UAE, it doesn't mean you have to pay taxes in UAE, because anyway there is no personal tax. What definition UAE has for an individual to be resident of UAE is you should be living here more than 180 days. But the catch here is, and this is very important, India financial year is April to March. UAE financial year is the calendar year, which is January to December. So if you are living here for more than 180 days in the respective financial year, you are eligible to get TRC, that is tax residency certificate from the FTA. Once you get the TRC, you have to inform India income tax by filing Form 10F, which is now replaced by Form 41, that I want to invoke the benefit of double taxation avoidance agreement. I am tax resident of UAE. This is my TRC. And then you file your income tax return. You have two options now. Whatever TDS has been deducted, if you have already sold the mutual fund, you will claim it as a refund. In case you are very proactive, you don't want the TDS to be deducted, like we were proactive in selling immobile property in India where we applied for lower TDS. Here, what we can do is, in case you are planning any redemption, you get the TRC, you file Form 10F or 41 now, and inform all the AMCs in India along with the relevant declarations and KYC documents that I want to take this benefit. Once the AMCs give you a written confirmation over an email, you do the redemption, there will be no TDS deducted. So then absolutely your money is coming in straight, and then we have to just mandatorily file the ITR next year, and there is no tax liability that has to be paid on that. Okay, I'm sure there would be questions around this. In the fag end of the session, we will take these Q&A around this part as well. So what if you have a taxable Indian income? It is important that you have PAN. Now almost everyone has PAN these days, and it is also mandatory that you file your ITR. What are the conditions making it mandatory for you to file ITR is, of course, where your income exceeds the basic exemption limit, that is 4 lakh if you are going for the new tax regime. Second, if you have taxable capital gain, so any irrespective capital gain you have, it is important that you have to file for the taxes and pay for the relevant taxes. And when we calculate the capital gain tax liability for NRI, we don't see these slab rates. So someone, for example, say has only long-term capital gain of rupees 2 lakh and he doesn't have any other income. So first 1,25,000 exempt, balance being 75,000. Though this 75,000 is well below the basic exemption limit of 4 lakh, we don't see such benefit when you are ascertaining the calculation of taxes for a non-resident India. On that 75,000, you are required to pay taxes at a 12.5%. Had you been a resident of India, this comes in. So if 75,000 is below 4 lakh limit and you don't have taxes, you are not required to pay any taxes. So this is another very important pitfall. You have to be cautious when you are ascertaining the tax liability of a resident and a non-resident. Dividend we have already talked. So in case you have not converted your demat account to NRI, you have dividend income, no TDS is deducted. In this scenario, you have to file taxes because the dividend income is chargeable to flat tax at a rate of 20%. This is special rate of tax. Even if you have 1,000 rupees of dividend, your tax liability due to the government is rupees 200 on that. If there is any unobserved loss you have, you can of course carry forward up to 8 years, provided you file your ITR before the due date. Then only you are eligible to claim or carry forward of losses to be set off in future years. And then of course, very important, which many of the NRIs miss upon, is in case any excess of TDS is deducted and you want to claim it as a refund, it is mandatory you file your ITR, and only ITR can be filed for 1 year at a time for purpose of claiming income tax refund. Of course, recently last 2 years back, government brought in a concept of ITRU, which is called as updated return. You can go back for 4 years and file, provided there is penalty applicable. Range is first year 25%, second year 50%, third year 60%, fourth year 70% total of your tax liability. And you are eligible to file ITRU only when there is a tax payable to the government. So it should not result a refund coming in. Then only you are eligible to file for your taxes in India. So when is the due date? So 31st July is the primary due date. This is the best time. So in fact, last week ITR has already been released, ITR 2. There was a question in the chat box before we started. So there is absolutely no change in the forms. It is the very same as last year. And for NRI, ITR 2 is the form. In case you have a business income, then ITR 3 is applicable. And in case you miss upon 31st July, you can always file your belated return till 31st December. Then certain disadvantages are there, like you cannot revise your belated return. Even if you find any mistake, you cannot do, which otherwise in primary, you can always do that. Carry forward of loss is not allowed. And then of course, penalty comes in and interest is applicable on like 1% per month. Okay. Now coming to the voluntary part, my question is, if you don't have a taxable Indian income, government is saying you are not required to file tax return in India. Should you still be filing income tax return in India, even if government is saying you should not be doing? Okay. So I have identified 5-6 possible reasons, and I always suggest that you should be filing your tax return, and there are various benefits available. Number one, if you are NRI in UAE, of course, there is no personal taxes. You are not filing your ITR here. If you are not filing ITR in India also, practically, you are not filing taxes anywhere in the world, and you don't have single document wherein you substantiate your residential status and possible sources of income to the government of India. So this document acts very well. Government doesn't charge you anything to file taxes. It is zero cost. So by filing income tax return, at least you get one document which says you are tax compliant. At least you have one financial record available. And in fact, for that matter, when you are filing an income tax return, you are more habitual of making your financial records very clear and organized also. So if you are preparing to file, you will have your bank statements available. You will have the income statements. Whatever TDS is deducted, you will know about that. In case you are not doing, you are absolutely away from that. And the second reason is very important. So as we were discussing, that TDS rate is always on a higher side. For you to claim it as a refund, it is mandatory that you file your ITR, and that is the only way you can claim it as a refund coming in. Sitting here, the 26A statement which we have, wherein the TDS statement is reflected, foreign IP addresses are logged. You cannot access unless until you register as an NRI on the Traces portal. So it is very important that you check your 26AS. also TIS and AS, that is transaction information statement and annual information statement, wherein all the transaction and income that have been done in your financial year are recorded on your PAN, and you should reconcile with that in particular before filing your ITR. It also helps in your eligibility for a loan or a visa for that matter. So today you are NRI, okay, you might get a loan or a visa. But tomorrow, if you go back to India for good, you become resident and you have to apply for a loan. First document any banker will ask will be income tax return copy for 3 years. And you can file ITR only for 1 year at a time. I have personally seen people to wait for another 2 years to become eligible to even apply for a loan. And this is for any kind of loan you have to take in India. And for that reason, visa also. If there any scrutiny assessment happening, if you have records available, it is very good that any officer is asking you a question, you will have your records available. And I will give you a very practical scenario. So usually notices come in when you are doing a major investment in India. So if you happen to buy a mobile property or mutual fund, or even you are making FCNR or NRE deposits, what does income tax department, and of late last 2 years we are seeing that cases are coming at a very high level, very volume level, the cases are being opened for NRI. What they do is they just ask you to prove the source of funds to get these investments done, and you have to explain all the trail, that how did you earn the income, where it came, how did you transfer, which bank account was used, including your foreign bank account, to show that you had that genuine and a bona fide income. So for you to get these bank statements at a later stage, it is very difficult. So while you are here, you can get your bank statements. You can always preserve in a hard copy and a soft copy both. And this will help you down the line if any assessment comes in. And also tomorrow, if you go back to India for good, your visa is done here, your bank accounts are closed, and income tax sends you a notice. So if it comes after say 3 years, now how do you imagine to get the bank statements from a foreign bank account which has already been closed 2 years or 3 years back? Your RM would have been changed. He is not at the same position. Bank account is closed, so bank is not returning you. I have seen people actually fly down from India to UAE, go to the bank and pay as good as even 1500 2000 dirhams to get your own bank statements for the past period. So to avoid that scenario, you should always have a habit to keep your bank statements organized, your credit card statements, your employment letters, contracts, your salary slips. These are very important documents which are helpful when any assessment of income is happening in India. And last benefit is, of course, if you want to carry forward the unobserved loss, of course, there is no taxes, no income, so there is okay. But if you have unobserved loss and you want to carry forward, it is mandatory you file your ITR before the due date. Then only you are allowed to carry forward the losses. And here also people do ask me that, okay, Ajay, I am a non-resident Indian or I am RNOR. Do I have to, disclose my foreign income and foreign asset? So answer is no. As a non-resident Indian, it is not mandatory for you to disclose your foreign income and foreign assets. However, the day you become ROR, resident and ordinary resident, it is important that whatever foreign income you have, you pay taxes on that in India, and also disclose all your foreign assets, because any non-disclosure foreign asset in India leads to penalty of rupees 10 lakh per annum, and you are governed by not the income tax but the Black Money Act. And it is very, very important. And these days the cases are on rise, and especially for the investments done outside India, department wants to know then how did you bought the investment, what are the sources of investments. So be very cautious and mindful for the fact that you have to disclose all your foreign assets. I will tell you a very live example. So I had an NRI who moved from Abu Dhabi to India in year 2016, and we were filing in his return for almost like 7 8 years. In 24, we received a notice stating that you have not disclosed a particular foreign asset, wherein we were very cautious. We were declaring everything. He had a bank account here, he had a property over here, he had some investments in US stocks. So we were carefully disclosing all the foreign assets. But while I was going through the notice, I perhaps found that he had an insurance which was not declared as an asset. Then I was like, how can insurance be not declared? And then I spoke to this client, and he said that this insurance was a particular company. So concept of jumbo insurance. So he bought this policy way back in 1996. So this is almost 3 decades back. He had paid for the jumbo insurance, which had a surrender value. That is how this became an asset. So any insurance policy which has a surrender value is also a foreign asset. So it was mandatory for him to disclose. Then we contested the case. There were good merits in the case, and we got the relief for the SSE because we were declaring all other assets also. Had our intention be that we don't disclose anything, certainly he was in a mess, and the penalty is 10 lakh per annum. And if you are not disclosing it for 8 years, it becomes 10 lakh into 8 years, which is 80 lakh rupees. So that is the magnitude of the penalty which comes under the Black Money Act. Okay. Next, let's talk about the bank accounts. So as a NRI, it is mandatory, and these are as per the FEMA rules, not with the income tax rules and regulation. As a NRI, you cannot continue have your resident saving account. I see a lot of NRIs still continuing that. It's matter of time. RBI is sending you a notice, and the penalties can be as high as 3 times the income that has been credited to that bank account. So all your resident saving account, it is mandatory you convert it into NRO. In addition, you can open an NRE bank account under the same customer ID, and you should preferably have both NRO and NRE in the same bank because transactions and convenience is there for the reason. And coming on the use type, so NRO account is a bank account you use to receive the funds you have in coming from a source which is India. So someone has to pay you in India, money can come only to your NRO bank account. So if you have investments like say you have real estate and you have a rental income coming in, so tenant is there. Tenant can pay you rent only in your India bank account. He cannot pay in your foreign bank account. Whereas NRE is non-resident external bank account. This is as good as a foreign bank account. This is for a reason if you have to receive funds anywhere from outside India. So if you are having a salary income coming in Dubai, you can transfer it to your NRE account, and eventually you can use this bank account to pay anyone in India. So payment you can do, but money cannot be directly deposited in your NRE account from a source which is in India. And what I say is you should be keeping minimum possible balance in your NRO account, and you should use NRE for all the reasons you have to spend, invest, or do any transaction in India. You want to give it to your parents, you transfer it to your NRE and use NRE bank account only to give anyone in India. And both are in INR. And third is not actually an account, it is FCNR, which is foreign currency non-resident deposit. It is basically a fixed deposit you can have in multiple possible currencies, and it can go up to many years depending on the bank you are going for. What is important here is because NRO is a resident account, it is an Indian account, whatever interest income you get, it is becoming part of your taxable income, and bank is deducting 30% TDS on that. So that is the reason I'm telling you keep minimum possible balance in your NRO account so that no TDS is also deducted. And if you have to make deposits, make in either NRE or FCNR. Both are freely remittable. There is no restriction on that. However, if you think that you have done any financial transaction in India, like you have sold a property, you have maturity of PPF coming in, or you have some money which you have received through inheritance, and you want to bring that money to UAE, as an NRI, you can bring in up to 1 million USD per annum per person, subject to 3 conditions. Number one, if it is a taxable income, tax has been paid on that. So surely TDS is covering that. And then 2 certificates are required. Form 15C now renamed to 145 in the income tax at 25, which is an online income tax form. And then there is Form 15CB now renamed to 146, which is a chartered accountant certificate. You give these 2 certificates to the bank. Bank will give you one single page form called as A2. You fill in that. Basis that funds can be remitted from your NRO bank account to NRE or from NRO to your foreign bank account. And any fund you have in India, you can remit up to 1 million USD per annum per person. A lot of time people get confused that there would be 20% TCS, limit is 250,000 USD. That is only for an individual who is a resident of India and wants to send money outside India. So if I'm a resident of India, I want to maybe buy real estate in Dubai. For me, the maximum limit is 250,000 USD per annum per person. And whatever remittance I'm doing outside India as a resident for investment purpose, then 20% TCS is applicable. Again, TCS is not a cost. It is like paying an advance tax. Whenever you ascertain your tax liability, if the TCS is more than your actual tax liability, whatever is the excess, government will pay you back as a refund. Coming that we are sitting in a point where this is a very apt time to start filing for tax return. This is a checklist which we have made, and we will just quickly run through that, and then maybe we'll open the house for Q&A. What is important for you is you should always access your income tax website. The portal is incometax.gov.in. Lot of time people don't log in, their email ID is not updated, their mobile number is not updated. So because all the communication these days from happening from the department is online and digital, in case any assessment notice has come in, it would be at the dashboard. And if you have not been responding to that, the officer has no option but to do the best judgment. And then when you find it, you go into the appeal, and then the problem starts. So be very sure that you are accessing your portal very often. Your email ID, mobile number is updated. In case you have an Aadhaar card, it is important that is linked to your PAN card. Okay. In case your PAN and Aadhaar are not linked, PAN would have already been made inoperative. So now you have to pay 1,000 rupees challan, the late fee, and link your PAN and Aadhaar to make it operative. Second, which is also very important, for people who don't have Aadhaar card and their PAN card, when you applied, I'm sure a lot of you were residents that time, resident in India, your tax jurisdiction is in a domestic ward. So as a good practice, you should migrate your PAN card from domestic tax to international tax office, because that is where all your assessment happen. If you have to make any lower TDS application, it is through international taxation. Or if any additional certificate or clearance is required from the income tax department, it is only international tax office which has a jurisdiction over you. So as a practice, you should do that. And when we are starting with the preparation of tax filing, what prominently is required is you have your all bank statements in India. So NRO is most important, because any income which is being received will come to NRO. NRE also is important, because if you are buying your mutual funds or shares from your NRE bank account, so even NRE bank account is considered. What prominently we see is all the credits in the bank statement and debits for any expenditures that are allowable, or exemptions if you are taking. Then if you have an asset in India, if you have to file your ITR, it is mandatory that you put in your address along with the PIN code, name of the tenant, PAN of the tenant, and the total rental you have. And municipal taxes deduction is allowed only if you have paid. And in case you have not paid municipal taxes deduction, you're not allowed to take the deduction. And then you have to apply for and take the interest certificate from the bank also if you have taken a housing loan. So before you start filing your taxes, if you have a home loan in India, ask the bank to give you the interest certificate, because we need to ascertain what is the component you have paid for the principal and for the interest. Salary India business is not very relevant. This is people who come and become NRI in a mid part of the year. So might be 3 months you worked and 9 months you are here. So then you need Form 16. And for people who have investments, so statement of account, P&L, balance sheet is required. And then if you have investment in shares, it is called as a profit and loss report. We need a detailed report from the AMC or the brokerage you are using or the platform you are using to do the trade. If it is mutual fund, it is called as capital gain report. If you are into PMS, you need a audit report. So if these three investments are there, you need to arrange and specifically ensure that capital gain report you are downloading. There are two options, either a detailed report or a summary. We need detailed, because detailed will have a classification of dates of purchase and sale, and also a column for long-term and short-term capital gain. And then if you have sold any property, so we need the sale deed copy, we need the purchase deed to ascertain the calculation of the capital gain. If the property was bought before 1/4/2001, you have to get the fair market value, the ready reckoner rate, that is from the sub-registrar office you have to get. If you are claiming the reinvestment, you need the relevant documents for the new property that you have purchased or you have bought the bonds. And also what you should do is, when you're downloading your bank statements, you should also download the annual interest certificate. So irrespective of you have deposits or saving account in your NRO, NRE, and FCNR, this is customer ID based, and you get a statement wherein it states that whatever interest you have gotten from all the sources, you get a summary in a single document. So this is very important. And in case you are going for an old regime, you want to take the deductions for ATC, ATD, you need to have the insurance premium receipt, mediclaim receipts, and DTAA we have already talked. So TRC is a very essential thing. I will spend a few minutes here. I'm sure those questions are coming in. So the reason why this has become more conflicting or confusing is the difference in the financial year. So India, we are talking about April to March, and UAE, we are talking about January to December. So in case you have done a transaction or planning to do a transaction between April to December, then only one TRC is sufficient to match the equivalent time frame, the relevant financial years for both the country. But in case you are planning to do a transaction or you have done a transaction between January to March, then in a case you might need two TRCs also, so that department knows that you have been effectively tax resident of UAE covering the entire period. This is very important. And if you are planning well in advance, so like today is financial year 26-27, or I should say tax year 26-27, I would be eligible to get TRC from UAE government for the current fiscal year only when I cross more than 182 days in UAE. So if someone who has not traveled, so July first week is the best time that he would get the TRC. The TRC he would be getting for 26 year would be valid till 31st December 26. So before this cutoff date, you have to inform all the AMCs and do the transaction, that is sell off your mutual funds, in case you want no TDS be deducted. And someone, anyway, not someone, that reason that, see, mutual funds investments we do are for a longer duration. So usually it's 5-year, 10-year plan we have that we put into mutual fund. While you are NRI, as a tax planning, what you should be doing is you can always reset your cost of acquisition. So sell off all the mutual funds with the information to AMC and rebuy. So at least whatever is your unrealized capital gain, you liquidate and book the profit and you claim the exemption from taxes. So tomorrow, if you're going to India, you will have a new cost of acquisition to calculate the capital gain, which is very efficient and a good tax planning that everyone should do, considering some or down the year, you have to relocate back to India. So these are a few very important points. So PAN and Aadhaar, PAN jurisdiction, we have already talked about. There is another restriction as per FEMA. So as a NRI, you cannot buy an agricultural land. To buy an agricultural land, you need to be a resident of India. Only exception for you to have an agricultural land is through inheritance. That is allowed. Third is about the PPF and Sukanya Samriddhi Yojana account. So as a NRI, you cannot open these accounts. What you can do is, if you have opened these as a resident, you can continue holding it maturity. Once it is matured, you have to take the proceeds to your NRO bank account. You cannot request for extension. And last is a very hot topic, very favorite of mine, and people laugh at themselves when I say these things. The wording is gift received from non-relative exceeding rupees 50,000 per annum. So any gift you receive in India from a non-relative exceeding rupees 50,000 per annum, this becomes part of your taxable Indian income. This would look very simple to you. Now let me tell you a practical scenario. Your friends come in from India. As a tourist, they will come. They will go here for shopping. They will go to Gold Souk to buy gold or to buy an iPhone. Always short of dirham. They will tell you that, okay, please help me with 10,000 dirham and I will give you 2,70,000 in your Indian bank account. The moment this 270 comes in, this is coming in from non-relative. This is a one-way transaction. This is a gift you are receiving, and this becomes part of your taxable income. Now ask yourself, in all the years you have been NRI, have you not done this transaction? So perhaps everyone has done this in transaction. So the reason I'm telling you this is you should absolutely stop doing this transaction, and this is bothering to a lot of NRIs now. So yeah, these were things which I wanted to talk upon, and thank you so much for all the hearing. And Manish, we can open the house now for Q&A.
Yeah, thank you, Ajay bhai, for taking us through exhaustive session, covering a lot of points, and it has been a great session. So I will open the forum now that I see a couple of questions being put up in the chat box. So I will read some of them and I will ask all participants also to raise the queries. And we will be sharing the presentation who has participated today and registered for this event. We will be sharing this presentation, which Mr. Ajay has shared. Okay, so I just read one question which is there from Sunit. Is asking, there is a property in India jointly owned by one resident and one NRI. How the intersection will be done and what will be the TDS rate?
Yeah, so this is a very general scenario, maybe wherein like two brothers own a property, one brother is a non-resident Indian, one is a resident. What we have to see is the taxation and TDS rules for respective share. Unless and until the percentage is not defined, it is always treated as it is equally owned, that is 50-50. So on your share of 50%, capital gain will be applicable as per the NRI rules and regulation, including the TDS rules. on your brother share or any person who is a resident of India, TDS and tax rules will be applicable as per the resident. So your brother will get the benefit of take indexation and pay 20%, or without indexation 12.5, and he can choose whichever is beneficial for him. And on his share, buyer is required to deduct 1% TDS. On your share, if the value of the property is above 1 crore, he will deduct 14.95% TDS. So that is how it happens.
Thank you. Hope that clarifies. So, Mr. Amit, you have raised your hand. You can unmute and ask question.
Yeah, Ajay, I have one query. I sold the mutual funds and submitted the computation and all with the deductions. Yeah, no means as a UAE non-resident. So the mutual fund capital gains are not taxable. Huh? So my refund was submitted, but I forgot to fill that 10F. So now they replied that since 10F you have applied as a non-resident and you have not filled 10F, so we will tax you as a on the full capital gain. So post, can I submit the 10F now and can I take the TRC from FTA now? It
So
is related
the
to March 25. Huh?
financial year 24-25.
Yes.
So the rule is you have to submit 10F before the filing of the income tax return, or in a reasonable case, at least before your income tax return has been processed. So since you missed both the timelines, income tax department will of course challenge you. What we need to understand is some facts of the case. We can always file 10F and at least apply for a rectification of the return, the same to be reprocessed. And if there is denial in the benefit, we should go for an appeal.
We should go for appeal.
It should be contested. So there are good reasons, because you had the TRC, and income tax department will go by the rule book, and depending upon the presentation of the case, this can be handled. So chances are less, but you should contest.
Fine.
Great.
Thank you.
So just related to the mutual fund, there is one question in the chat box. So I just thought of reading it out. Given that tax rate in UAE is nil, can we not claim full exemption on the capital gain on mutual fund under the UAE and the India DTA?
So that is the whole planning we are doing. So as per the DTAA, we can claim the exemption on the mutual fund you have, be it short-term, long-term, or any of the capital gain you have sale of a mutual fund. For this, you need to inform the India revenue that you want to take the benefit of DTAA. So TRC is an essential thing wherein you have to file Form 10F. In that Form 10F, only we attach the TRC and state that we want to take the benefit. And when you are filing your ITR under the schedule that you are filling in the capital gain, you have to invoke the article of the double tax avoidance agreement and claim the tax rate to be 0. So this is doable.
Okay.
So full capital gain is allowed as an exemption.
Yeah. So thank you, Mr. Pramod. You can unmute and ask your question, Mr. Pramod Murkia.
Yes, sir. My question is whether the this is regarding non-resident, your residential status. The employment covers whether means the person who left India in UAE and has own business. Whether employment cover
very
own
much
business
covered.
also?
That is also covered. There are judgments available wherein your self-employment is also considered as an employment. So it is not by literal mean that you work as a salaried employee, then only you are covered as an under the exemption of employment.
All right, got it. Thank you.
Yeah. So I see one question on the TRC charges. So the government fee is 1057 dirham to get the TRC. And before you get the TRC, you need to get the immigration report. So if you are a Dubai-based resident, you can either get the immigration report from the Dubai Now app or the Amer Center. If your visa is from another emirate, like say Abu Dhabi or Sharjah, you can get the immigration report downloaded from ICP app. And there is a cost which ranges from 170 to approximately 240 dirham to get the immigration report. And when you are applying for the immigration report, be it for 1 year or 2 year, cost is same. So as a practice, you can always take immigration report for 2-3 years to have it for your record purpose also.
Yeah, great. Thank you. So I can see Ambika raising hand. If you can unmute and ask a question.
Yeah, hello. Thank you, Ajay, for the presentation. I have a question. Like, I have bought a property which is under development, and for which we have a home loan. Now, the interest which I'm paying now, can I claim it when I rent the property once it is developed under the deduction?
Against the rental income, you mean to say?
Correct. Yeah, yeah.
No, so residential property you are not allowed. In case it is a commercial property, you can allow it as a deduction.
A
Against the
residential,
rental, for residential you cannot.
but we discussed now that interest which we during the renting of the property, the interest we can claim.
No, so what you have to see is when the property is under construction and you pay the interest, that is added to the cost of property. You mentioned it is under construction.
Correct. Yeah, yeah. So that
So
I can
under
add to the cost
construction,
of the property.
under construction, it is added to the cost of property. Post construction, you get the deduction if there is a rental coming in.
Okay, got it. Yeah, yeah. And one more, if I can, I was not when you said about interest and dividends, you said one point regarding the lower tax. Can you please repeat that point? Like,
So that is,
it does it that comes under TRC? Like, if I have a
yeah.
TRC and
Yeah, that is also part of the DTAA benefit you get. So like we were talking about mutual fund capital gain exemption. So the DTAA, there are almost 31, 32 articles, and every article is a different paragraph which talks about various incomes you have. So dividend income is also covered in that. So from 20%, you can reduce it to 10%. And interest income, if you are under 30% bracket, you can bring down to 12.5%. So as per the understanding of the DTAA, you can very much do that. So, but requirement is again TRC Form 10F and claiming the benefit in ITR.
Okay.
thank you.
So
Thank
yeah,
you.
thank you. So Ms. Poonam, you can unmute and raise your question.
Yeah, hi Ajay, Poonam here. I actually have written a question in the chat box also. We've just sold a property. We've just received some token amount now at the moment. Not applying, planning to apply for a lower tax certificate due to urgency of the buyer. He needs a property very immediately. So we plan to allow him to deduct tax. But my question is that the apartment in Bombay is in my husband's name, and his PAN card has first name and surname, whereas Aadhaar card has surname first and first name later. So will this cause a problem in registering the apartment in the buyer's name, or when he's deducting TDS from us, that 15%, whatever the higher rate, and when eventually we claim back during our annual return, will it have a problem?
So absolutely no problem. What you have to follow is only the PAN card for that reason. So PAN
Okay.
number is important, not the name as per the PAN card.
Oh, perfect, perfect.
Yeah.
And also, like, now we're also buying another property. During that agreement registration also, we will not have a problem, right? Because the new seller is a resident, so we are deducting only 1% from whatever we are paying. That will also not have a issue.
No. So what you have to see is 2, 3 things. Number one, ensure your PAN and Aadhaar is linked. In case you have an access to Aadhaar OTP, what you can do is immediately file for your PAN correction. So anyway, your problem will be resolved.
No,
And
we
within a
tried
week's
that.
time,
I tried that, in fact, but then Aadhaar OTP is not coming only. Apparently, there's some problem going on since yesterday of this
okay. So in
OTP.
case Aadhaar OTP is not coming, you can
Yeah.
request for the offline processing of the PAN correction so that your
Okay.
name is updated to match the Aadhaar. So once for all, this
How
should be done
long does
anyway
that
because
take?
it should be done within a week.
Okay.
It is quick to do.
So it
And
is better to do it.
considering if it is Mumbai, I think 1 month is a good time to get a lower TDS certificate or earlier also. So if you have 1 month time, you should think on that part.
Oh, there is a lot of problem because in traces our phone number is given, which was like this property was bought in 2012. Apparently that time we had some other phone number, and then we cannot get hold of that phone number. So the OTP which is coming is giving a big problem. So we've kind of tried all sources, which is not happening.
So these are the things which I covered in the checklist that you have to be very cautious about your
Yeah.
email ID, mobile number on the income
Yeah.
tax basis portal. So these are the challenging times, and when the need comes, you realize that this is not done,
Whereas we've been
and there is
continuously
always a
fine.
regret then.
we are filing our returns, and in the return we have the new phone number. Apparently traces and the income tax is not connected, the phone number. I mean, it should be changed there as well, right? It's actually a tax, income tax itself,
It should be. It should be.
but it is not. So that is not happening. And okay, so you suggest that we should change the name, apply for the change name, meaning match the Aadhaar.
You should.
Okay. Okay.
Okay.
Thank you,
All
Miss
right.
Poonam.
Thank you. Thank you.
We,
Thank
we
you.
have
Thank you.
other questions, people raising their hand. Yeah, Mr. Yoga.
Yeah, thank you, Ajay, for the insightful presentation. I have a question. I have a joint account in UAE with my wife, and she became an RNOR last year. So does she need to disclose in her IT return the bank account in UAE?
So disclosure requirement of foreign income and foreign asset under the Black Money Act comes in only when your residential status is ROR. So while you are
Okay.
NRI or RNOR, you don't have to do.
Okay.
Moment she becomes ROR, even if she is a beneficial account holder or a joint account holder in any foreign asset, disclosure is mandatory. So
Okay.
even if
Okay.
you are first account holder, she is second, because she has an interest or a beneficial part in the bank account or any foreign asset, it is mandatory for her to disclose in the India income tax return.
So she needs to disclose 50% of the balance, something like
Correct.
that.
Correct.
Yeah.
But once she is ROR, not now.
Yeah. Okay. Thank you.
Yeah.
Thank you, Mr. Yoga. So there's another, I just question in the chat box I want to read out before I call up others to take up the questions. So Mr. Shreyas has mentioned, if someone is resident in UAE and spends more than 180 days outside India, but is actually filing a return in India as an ordinary resident. Also, this person is not employed in UAE, and can the risk of any tax liability on the asset of this person outside India arise?
So we need to, of course, deep dive into the case, because on what visa is outside, what is the structure, all these are important. So I think I will skip this question.
Okay, fine. Yeah, Mr. Dilip, you can raise your query.
Thank you, Ajay, for the wonderful session. My question is regarding TCS exemptions. Is there any exemption for TCS, like someone want to open a company and is a resident of India, and you want to brought in capital for his newly opened company, or want to establish a company in UAE?
So first 10 lakh there is an exemption. When your total remittance in a particular financial year, including all the sources that you are remitting outside India, exceeds 10 lakh, then only 20% TCS comes in. So first 10 lakh is the exemption.
Okay, so for that you need to file any form or to RBI or to bank or something, or directly you can remit?
So when the remittance happen, bank is required to deduct and pay that TCS to the government. So in case you want to transfer, say 5 lakh rupees out of your resident account to a foreign bank account, you should have a balance of 6 lakh available. So 5 lakh plus 20%, that is how it has to be done. So when you have a balance of 6 lakh, 5 lakh goes to the UAE company and 1 lakh to the government as 20% TCS. As an individual, you don't have to do any compliance. It is on the bank to do it.
Okay. Now I'm asking, is there any exemption to not deducting TCS? Like without deducting TCS, they can transfer, because this 20% will be on hold for like 1 year, and once they will file the return, then only they will get the refund or adjusted.
There is no exemption to that, sir.
Oh.
So,
Yeah.
but someone who is paying taxes anyway is required to pay also advance tax in India. To that extent, your advance tax liability is reduced if TCS is already there.
Got it.
Okay.
Thank you.
Thank you. Hope that addresses the questions. Mr. Pratik, you can unmute and ask a question.
Yeah, thanks, Ajay. Very insightful, very useful, and thanks, Manish, for organizing this. So, Ajay, my question is the other way around, which means that your investments, let's say your properties, etc., stay in Dubai, but you have changed your residence, your status to R and OR. In such cases, when should the investments be disclosed in the ITR? That is, should it be on a first return being filed as ROR, or should it be before that?
No, I am sure first the entire body of ICI Dubai deserves a good round of applause for taking this initiative. And this is a very important topic, and a lot of misreads are there. WhatsApp University, you know how it works. So there is a lot of misconfusion. So thank you again, ICI Dubai, for having me here and giving this opportunity. And Manish, yes, took a lot of efforts to have this session organized. And coming to your question, so you are required to start disclosing your foreign income and foreign asset only when you become ROR. And every time you are ROR and you have a foreign asset, it is mandatory you disclose. So while NRI or RNR, it is not required to be disclosed.
Fine. And then the cost of that acquisition. So let's say if the mortgage continues till date and the asset might have been purchased 10 years back, then the interest that you continue to pay, how do you account for that as within your cost of acquisition?
So that is allowed as a deduction when you are calculating the capital gain. And in fact, when we calculate the capital gain, there is a very big difference how you calculate the capital gain. So someone say like you bought a property at say 200,000 dirham and you are selling it now at say 800,000. So for you, capital gain is 600,000 dirham and you will multiply it by today's rate and that becomes the capital gain. That is not how the capital gain comes in when you have a foreign asset. To actually calculate the capital gain from a foreign asset, what we do is purchase price was 2 lakh dirham and maybe it was in 2010. What was the rate of dirham at that time? We have to see. Multiply it, that becomes my purchase price. Right now I'm selling at 8 lakh dirham. My conversion rate today is at 2550. That becomes my sale value. Difference between these two is my capital gain, and on that I have to pay taxes. Also, if you are a resident of India, you are selling a immovable property, you have both the option now to choose. Either you take the benefit of indexation also and pay 20% tax, or without indexation 12.5. So wherever your tax liability is less, you can do that.
So I have that choice as an NRI who has become a resident.
As an NRI, of course, that is exempt. You don't pay any taxes. But when you are resident, it is a taxable thing, and you have a choice. How do you want to calculate? Or another alternative is sell off the property while you are RNR. You don't have to pay any taxes on that.
Right. And for the mortgage, the interest that you have paid, let's say the mortgage ended 10 years back. So you have to find those documents to show that this is the interest that you paid.
So interest cost only for the pre-construction part. Before the possession, you pay whatever interest is added to the cost of property, not after that.
But for that also, we need to support it with the documents.
100%. So any deduction or exemption you claim, it is always supported by a documentary evidence. So you will need proof of statements or the interest that you have paid to the local banks. Then only income tax will allow. Otherwise, they will reject the claim.
Yeah. And if the rental income continues, then are there any exemptions which are available on those rental income that you're...
Same 30% standard deduction you get to cover all the expenditures.
And section 54?
So 54 is not for the rental income. It is only when you are selling the property.
Yeah, for the sale of
Yeah, so
property.
54 is available. In case you sell a property and rebuy a residential house in India, you will get the benefit of that.
For foreign assets also.
Foreign asset also.
Is it complicated in terms of filing and the assessment of such returns?
So this depends. So for me, it is not, because we have been doing it on daily basis. So for us, it is not a complicated thing. But as an individual, someone who doesn't understand NRI taxation, I am sure it is very, very complicated.
And any tax planning tips that you can share with respect to this particular situation?
I'm sure we can connect a one-to-one on that part. And
are you based out of UAE or India?
So I work on a hybrid model. So right now I'm in UAE. So I do travel between India and UAE, and in fact I do travel to almost 15 plus countries around, and we have a good presence around various geographies. So, but yeah, on an average,
meeting you. It would be worthwhile meeting you. I'll try to connect with you.
Absolutely. So Pratik, I think you need to have a consultation.
Manish, very quick one last quick question. So Ajay, what happened was that one Indian bank, it deducted TDS, and I was not aware of it. I filed the return without claiming that TDS because they had not issued form AS or whatever by 16. That point of time. Yeah. Subsequently, I found out, I chased them, and they issued it, and it was reflecting in the income tax portal. However, by that time, already 2 years had passed. So is there a way in which I can claim that TDS?
So because you can file for income tax return to claim refund only for 1 year at a time, and there is a reason that because Form 16A was issued late and the bank filed it late, what you can do is you can file for a rectification of the income tax return to give you credit for the TDS that was deducted earlier and you have
I
not claimed.
tried that, but it's not accepting any kind of rectification.
While you filed your ITR, did you claim the credit?
No.
Because
credit,
so
yes.
that is
Credit,
what
yes. No, credit I claimed, but not the TDS.
No, so what you should have done is, even though if it has not been reflecting in your 26 AS, you should have claimed in your ITR, department would have denied, and once it is updated, you file your rectification in
Correct.
the ITR.
But that was
You
not
will
done.
get
So
the.
is there a way in which we can claim it now?
I don't think so. I don't think so. Chances are very minute.
Okay. Okay. Once again, thanks a lot, Ajay and Manish, and I'll connect with you, Ajay.
Yeah, connect with, I think his number is displayed here and he is available in UAE as well. So take his
How
time.
long are you in UAE, Ajay?
I'm flying back tomorrow to.
But he generally comes in regularly, so he's spending good time in UAE as well. So you can take his
Nice.
time.
Thanks a lot, guys.
So yeah, Miss Punita, you can unmute and raise the query.
Yeah, good evening, and thank you for such a wonderful session, and thank you for our Dubai chapter also. My question is that as an NRI, can I take up a directorship in a private limited company in India, and do I need to declare, in the return there? And can I be a co-owner, like can I be a shareholder in a private limited company in India, and what are the implications and declarations I need to do in the return in India?
So answer to both the question is yes. You can be a director in an Indian company. You can be shareholder in an Indian company. And when you are taking the directorship, what you have to do is become an NRI director. Your KYC documents are to be apostilled by the local embassy. And that is an essential thing to do. A lot of time I see a mistake that people who want to become a director become as a resident director. So that is absolutely not allowed. And that is violation of the rules and regulations of the SEBI as well. And whatever remuneration you are getting, it would be again subject to TDS provisions under Section 195, Old Income Tax Act, and 30% TDS is to be deducted on whatever remuneration you are getting. Rest everything remains same. There is no change.
And what about taking up shares in a Indian private limited company? That's
You can
okay?
do that. Shares, absolutely, you can do. You can be a normal shareholder. There is no concept of resident shareholder or a non-resident shareholder. You can directly subscribe to the shares of the company. So as such, no compliance is there. So for company, it has to be done. You will have to tell them you are an NRI shareholder. That's it.
Okay, thank you so much.
Yeah.
Thank you. Can we have a question from Mr. Wakar?
Thank you very much, Ajay ji and Manish bhai, for this wonderful session. The one question I have got is about the NRI is the owner of an apartment. Okay, of course, a capital gain is applicable in case of the sale proceed is available and the apartment is sold. But here in this case, he is gifting that apartment due to some reason to his own child. Okay, so what will be the implication of the capital gain? One thing, and second, in terms of the stamp duty, is there any concessional stamp duty for the gifting to the own children?
Okay, so there is a mix in the question. What you need to understand is, first of all, if you are NRI, your son is NRI, you are gifting, whatever DLD charges you pay. Okay, let me re-ask you. Was this a question for a Dubai property or India property?
No, it is an Indian real estate property, residential property.
Okay. So absolutely, you can gift the property to your blood relative, and transfer of ownership happens. Whatever is the stamp duty you have to pay for the gift deed that has to be paid. However, this is not a sale transaction because there is no money exchange, there is no consideration involved. Whenever your son happens to sell the property, that is an event when it is called as a capital gain event. For him, the sale value he would know that whenever he is selling a property, and for him to calculate the capital gain, cost of acquisition would be the original purchase price paid by the original buyer of the property. So if like it's your property you bought in 2008, whatever price you paid in 2008 is the cost of acquisition for the purpose of calculating of the capital gain.
Okay. Fine, clear. But most probably, he or she will be using for his own accommodation. So that is now clear. Thank you very much.
Thank you. So can Askar ask the question? Please unmute and ask your question.
Yes. So thank you, Ajay Bhai and Manish Bhai, for such an insightful session. So my question is, suppose I am having an HUF who are investing in the property or some investment in the India. My PAN card is of HUF, not of a resident or personal PAN card. So how the tax liability will come if I am an NRI, but other members of my HUF is Indian resident? So whether HUF will be considered and the tax liability, TDS deduction, everything will be considered as a normal residential clauses, or will it considered as a non-resident computation for the purpose?
Okay. So when we have to ascertain the residential status of the HUF, we see the residential status of the Karta. So if Karta happens to be NRI, status of HUF also becomes non-resident.
Okay. Okay. So accordingly, all the tax liability and computation will change.
All the provisions are equally applicable as NRI then.
Okay. Perfect. Perfect. Thank you. Thank you.
Thank you. Mr. Yoga, you can unmute and ask your question.
Sorry, Ajay, my wife, if she becomes the ROR, resident and ordinary resident, what will happen to her NRE PIS holdings and NRE account? Will it be repatriable or she cannot?
So now there are two things here. Once you become resident, you cannot continue holding your NRO or NRE. So even your bank accounts or even your PIS accounts, you have to convert. So FEMA says once you are a resident of a person of resident, a person resident in India, you have to convert your NRO, NRE bank accounts to regular resident accounts, and whatever assets are that are transferred to your resident account. So you cannot continue holding your NRE bank account or NRE PIS account once you are a person of Indian origin or Indian resident then.
So I cannot repatriate those balances because NRE it was a non-resident fund which was repatriable till as long as she was a non-resident.
So NRE you can have only when you are a non-resident Indian.
No, but the repatriability of the fund, it will be treated like a resident repatriation.
Like a resident then.
Or can she gift that to me, to my
Possible.
NRE account? That is possible. Right?
Possible.
All the shares can be gifted to me and it can continue in my name.
Possible.
Yeah, okay.
Thank you. Yeah, Snehal, you can unmute and raise your query.
Yeah, thank you, Ajay and Manish, for this wonderful session. My question is also, further to what was asked by Mr. Yoga. So if a person becomes RNOR, okay, what happens to his investments and bank accounts, like when he had opened, when he was a non-resident? Of course, I understood that disclosure will come only when the person becomes ROR, right? But when he is still RNOR, is it possible to, say, transfer these investments in the name of, say, spouse who is still non-resident?
So until you are RNR, whatever continuing foreign income you have, so like if you have say investments in US into stock, whatever capital gain comes in, you don't have to pay any taxes on that. If you have rental income coming in from having a Dubai apartment, you don't pay any taxes on that. FCNR deposit you have, whatever interest you get, that will be exempt until you are RNR. But the moment you become ROR, your global income becomes taxable in India. And regarding the deposits part, like say FCNR you have made while you are NRI, you can continue hold it till its maturity. So it is not that you have to close down that deposit and mandatorily convert it into a resident deposit account. So that is not a thing. So first year, like say today I am NRI, I make an FCN deposit for 5 years. So today I am NRI, first year anyway is exempt. I qualify the condition, I become 2 years RNOR. So second year and third year, whatever interest I get is again exempt. Fourth year and fifth year is when I become ROR. Whatever interest I get, that component becomes part of my taxable Indian income.
Correct. So my question is like when a person is still RNOR, it is possible that it can be transferred to a person who is non-resident. That is possible,
Possible.
right? Yeah.
But
Even like whether.
how do you transfer the deposits? Deposits you cannot transfer. Other liquid investments you can always do that. So if you
Right.
have shares, you can transfer to someone, but deposit you cannot transfer.
Okay, so the only way would be to premature the deposits and then maybe by way of gift, or because it will be in the joint name, like husband and wife. So I'm not sure, like practically how this will be done.
With the proper planning, this can be executed, but what assets cannot be transferred cannot be done. So like if it is a immobile property, you will have to make a gift deed to transfer the same. So you will have to pay DLD if you have a UAE property. Then you can of course transfer
Yes.
then whatever rental income comes in and your husband continues to be NRI. So you will have to pay no taxes on that.
Right. Okay.
Yeah.
Okay. Thank you so much.
Yeah, thank you for that query. I think we have addressed most of the queries and most of the people who are around who has raised their concerns. I think one query that we'll just take one or two questions more and we'll wind it up. So yes, Sana, you can unmute and raise your query. Sana, you are there? Okay. Otherwise, Shrikant, you have also raised your hand if you are there, just ask question. Yes.
Hello.
Okay, I think okay, Sana, you can go ahead first.
Okay. Ajay, my question is like I've been in this place for 3 decades and I'm retiring and I have my end of service. Now, if I keep it in Dubai, because I have come back to Dubai and I've got a freelance visa, can I send this money to India? Will it be taxable?
So we need to understand what was the first point of contact where the money was received and your residential status when money is received. So if you are NRI, you have the received in Dubai, it is anyway tax free. This is your money. You can absolutely transfer wherever you want. You want to transfer it to India, to someone of your relative in India. There is no tax incidence because this is income which is received outside India, income which is accrued outside India, and the status is NRI while you were
Yeah.
working outside. So there is no tax impact on this.
So, but now if I go back to India, if my status will change, then this amount will be taxable? My
No,
end
so
of service, if I transfer?
whatever income you get over and above, like if you invest this money somewhere and you get some returns out of that, and you are ROR in India, then that interest or any income that you are making out of that balance, cumulative balance, that will become taxable, not the principal amount.
Not the principal amount. Okay. Okay. Thank you. Thank you so much.
Thank you. Yeah, Mr. Srikanth, you can go ahead with the query.
Thank you, Manish. Thank you, Ajay. Thank you so much for the insightful, training. Ajay, my question is concerning mutual funds and alternative investment funds. See, for mutual funds, there is the DTA benefit for non-residents based in UAE. And what I understood was that if you want to avoid the tax deduction at source from the AMC, then the exercise has to be done every year where you file the TRC and the Form 10F. Whereas the advice I got was rather than that, let the TDS take place, and after that, while filing the return, better to claim it as a refund instead of doing this as a yearly exercise. Do you think that is advisable, because that is better for a simpler way of doing it, right?
So the whole difference is if you can be proactive or you want to be reactive. So if TDS is deducted, of course, the route is when you are filing your ITR, you claim it as a refund. But then your capital money is being blocked for almost again say 12 to 18 months. And if you don't want that to happen, you can of course proactively. It will absorb a lot of time and efforts to be done, but that is doable. So given the option that you have time to do, you have energy to do, you should inform all the AMCs in advance. And mutual fund, I always say that this is not an investment you do and do redemption you do every year. This is perhaps once in 4 or 5 years you will do, and it makes sense to do in 1 4 5 years to do this activity and ensure no TDS is deducted. The another reason I'm saying this because once you are claiming a lot of refund from the income tax department, it is absolutely a red flag. So there is chances that notice will come in, assessment will happen, and of course there are merits you will win. But when there is no TDS refund to be claimed, possibility of assessment coming in is very less.
Okay.
So that gives you a lot of advantage and comfort zone, I would say.
Okay, and a quick follow-up. Are alternative investment funds also eligible for DTA benefits because they operate very similar to mutual funds?
No, so it depends, alternative investment fund, what income you are getting. So if it is an income coming in from mutual fund, then you can get the benefit. But if it is general asset, other category of assets coming in, it is not applicable. Same is for PMS. So PMS does only equity shares. So it is not applicable.
Got it. Thank you so much.
Thank you. Thank you all for participating today. So with the looking at the time now, we will limit the questions. So the details of the Mr. Ajay is there on this page. So you can see the contact number and his email ID. You can reach him out and he can advise you any specific queries what you have and consult him for whatever support you require on the NRI taxation. So thank you, Mr. Ajay, for taking the time. And I know we have been interacting to schedule this. And with the changes schedule, you have accommodated your time. It's so kind of you that you're able to manage the time and be here. And it was a quite exhaustive session. And I can see the feedback given by our members. They really liked it. And I think you had been quite insightful. And definitely with the kind of updates coming in and the changes in the tax laws coming in the India, we need to be updated about it, and we need to be aware that how those impact our income in India and what kind of transactions we should be carrying out. So thank you once again, Mr. Ajay, and we look forward to have more sessions and maybe some physical session in coming months, and we will definitely plan out. So thank you again, all the members who joined in today. We will be sharing this presentation of what Mr. Ajay has presented today, and we have your email IDs who have participated today, has attended the event. We will share to our them. Thank you.
Thank you. Thank you so much once again, all the members, the core governing body members at the ICA Dubai, including Chairman Rishi, Secretary Ashna, and Manish Bhai for having me here. I'm very happy to address the members at large. So I have been traveling. I have done sessions for a lot of ICA chapters in the past, but this was one of the sessions I enjoyed the most.
No, thank you. I think you have been patiently addressing those queries and and that individual specific scenarios. But yet, it was great event. That you address all of them. Thank you. Thank you all.
Thank you
So
so much.
have a nice week, nice evening. Thank you.